Option dealers like Citadel and BlackRock use complex strategies known as delta hedging and gamma hedging to manage their option portfolios. And the effects of these strategies can create well-defined supply and demand zones in the market where dealers are aggressively trading. So as a trader, I want to determine where these supply and demand zones are and then analyze what dealers are likely doing at these levels, with the goal, of course, of making money in my own trading strategy. Here we're looking at a chart of the SPY, and on the right side here in purple, we have real-time gamma exposure levels, as well as in the blue, we've got options volume by strike price. And basically, we're taking all of the option contracts across every expiration for the entire SPY options chain and then calculating the same gamma exposure levels that option dealers use in their own analysis. So this does several things for us. Number one, it shows us where the main gamma exposure concentration levels are. For example, here we see between 530 and 535 is the bulk of the gamma exposure concentration on the SPY. And so this concentration zone, or dealer cluster as we call it, shows us that there's a lot of market interest at these price levels. It also tells us that option dealers are going to be the most active between the 530 and 535 level. Now, if you're not familiar with how gamma exposure works, be sure to check out our playlist. I'll put a link in the description below. One of the first data points that we want to look at, though, is total gamma. This number will actually tell us whether gamma exposure is positive or negative, and that's important because it can impact what option dealers are doing under the surface. The next data point we want to take a look at is how positive or how negative it is. If we just look at total gamma by itself, this is around 805 million on the SPY currently, and this number is relatively meaningless unless we have something to compare it against or benchmark the number against. And so if we look back in history, the SPY has traded anywhere between negative 4 billion and positive 4 billion gamma exposure. Now all of a sudden this 805 million gamma exposure number actually has a lot of context for us because we can see that we are in positive gamma exposure, but we are nowhere near any kind of extreme level. So when gamma exposure is positive, dealers will actually hedge themselves by selling shares of the underlying security as price goes higher, and then buying shares of the underlying security as price goes lower. And they do this in order to balance out their options book because dealers are making a market in the options market that they're trading in, and so they have to hedge themselves in order to manage their risk. Basically, what this means is that as the SPY goes up, in a positive gamma exposure environment, dealers are actually selling shares of the SPY, which compresses volatility and then reduces the overall upside and downside movements of the SPY. However, we've noticed something else that often occurs, and that is that price will oftentimes pin or tag the largest positive gamma exposure concentration. And that's typically because there's so much market interest at those particular levels. So for example, here on the SPY, we can see the largest gamma exposure concentration is currently at the 530 strike price. And that's been the case for the past several days, indicating that the majority of market interest is targeting this 530 strike price. This is something that changes in real time, and we actually track this in our Discord. So definitely check that out if you get a chance. But if we go back here about a week and we look at when the SPY was trading at 520, we saw there was large gamma exposure concentration between 521 and 525. And so it looked to us like market interest was continuing to grow at higher and higher strike prices. Take a look at the SPX, the S&P 500 itself. The total gamma exposure was also very positive, with the largest concentration at the 5,300 level. This data gives us crucial insights into how the market is positioned, what strike prices they're focused on, and what expiration dates they're focused on, because this is all data gathered from the options chain. So now let's take a look at the flip side. When gamma exposure is negative, what are option dealers doing in this scenario? Well, dealers will hedge by selling shares of the underlying security as price goes lower and buying shares of the underlying security as price goes higher. This is the opposite of what they're doing in a positive gamma exposure environment. So negative gamma exposure environments actually signal volatility expansion because dealers are often trading with the market in a momentum frenzy, whether the market is going higher or going lower. And this basically just adds fuel to the fire because dealers are fueling the momentum with their buying and selling rather than going against the momentum. And so we notice the same thing often occurs here, where price will pin or tag the largest negative gamma exposure concentration. Again, because that's where everyone in the market has an interest. So there's a lot going on under the surface that gamma exposure helps us to analyze. Now let's talk about how we approach trading SPY options based on this data. But before we do that, if you guys are interested in accessing our gamma exposure dashboard or going through our Geek University course, which focuses on gamma exposure and option strategy, consider becoming a member at geeksoffinance.com. We've got a couple of different pricing tiers and a great trading community, so you definitely want to check that out when you get a chance. So now let's talk about how we approach trading SPY options based on this data. As we mentioned, the bulk of the gamma exposure concentration and the bulk of the volume today is right around the 530 level. You can see gamma exposure goes all the way up to 535. So we know this is an intense area of market interest. We have options expiration actually tomorrow. So if we were wanting to trade like a 0 DTE or maybe like 2 days to expiration type of play, we could put on, for example, a butterfly spread targeting the 530 strike here, which basically has the intention of capturing that theta decay as price hovers around the 530 strike. If we had a slightly more bullish tilt over the next day or two of trading, we could easily sell the 530 puts, or we could buy a 530, 535 call debit spread. These are all choices we have based on our risk profile. But the crucial piece of data is knowing that the market is focused between this 530 and 535 level. But let's say we have a longer term horizon and we want to put on a position going out into the next month. Well, we could come over here to our 3D gamma surface. Here's the expiration that expires today and tomorrow. You can see it's mostly focused at this 530 strike. But if we just come forward in time, this is showing us how the options chain looks like going into the future. We can see there's another large gamma exposure concentration at the 535 strike, and this is at the end of May 31st expiration. So if we had a little bit of a longer time horizon, we could go out into the May 31st or even June 21st expiration, for example, 2 to 4 weeks out, and put on various strategies that take advantage of movement into the 535 strike. So in that example, we may decide to put on a put credit spread going out 30 to 40 days to expiration into the June expiration, for example. So we may decide to sell the 530, 525 put credit spread. Again, depending on our risk reward profile that we want to build for ourselves, we could also target the 535 concentration by buying a butterfly spread with the body of the butterfly in that May 31st expiration at the 535 strike. So these are the basic building blocks that we use to analyze the market, see where the main gamma exposure concentrations are, analyze what dealers are likely doing at these levels based on whether total gamma is positive or negative, and then formulate a high probability trading strategy using the options market and the other data points in our trading arsenal. So we've been mostly focusing on SPY, and we talked a little bit about SPX, but there's a broad number of tickers that you can concentrate on: ETFs, individual stocks like Nvidia or Apple, for example. And we could basically perform this analysis on any ticker that has a liquid enough options market. If you're interested in learning more, definitely check out geeksoffinance.com. Our membership includes access to our gamma exposure dashboard, as well as access to our Geek University 5-hour option strategy course focused on gamma exposure. You'll also get access to our vibrant trading community in Discord, and so you definitely want to check that out when you get a chance. Thanks so much everybody for watching, and we'll see you guys in the next video.